Markets off to a rocking start this year, but according to our very own Brian Sozzi, it's making for a bizarre time to be an investor. For more on this, let's go over to Sozzi to break down this morning brief. Sozzi.
Hey, I'm over here now, Brad and Julie. Let me tick through these right now. We have the full morning brief on the Yahoo Finance homepage. Check it out. But a couple points here worth making and why I'm calling this just a very bizarre time to be an investor. It's always a bizarre time, but right now is super bizarre. First up, like Michael Antonelli was just saying, this so far has been not a very good earnings season. We've seen a lot of earnings not only just decline year over year, but flat out miss consensus estimates, and the outlooks for earnings and even sales, I should mention, not exactly good. Number two, the layoff beast has been unleashed, yet stocks are still rocking. All these layoff announcements started to come from Microsoft, Amazon, you name it. They have now started to spread to the industrial sector, like a 3M when we learned when they reported earnings last week. I suspect you might see some layoffs now coming from the consumer space, but again, they report earnings in February. And last but not least here, no clear sign the Fed chief will be a dove, yet stocks are still rocking this month. And of course, guys, we'll learn more about that tone from Jay Powell when we have that big Fed meeting this week.
Yeah, I mean, it's not the first time that we have seen stocks go up at a time when, or risk on at a time where it's not exactly clear that they should be. I was just looking at the groups in the S&P and what they've done so far this year. We have communication services as the top group. That includes stuff like Meta, right, and sort of the social media companies. Consumer discretionary is number two. At a time when we saw consumer spending, we got the numbers last week for December. Consumer spending in December fell, and yet consumer discretionary stocks are up. And finally, tech stocks are in the number 3 spot. Then you have real estate after that, by the way, which is traditionally a defensive group. So,
yeah, nobody cares about this.
So bizarre, but I mean, that is bizarre indeed, right? Yeah. That we see that kind of mix of cyclicals and then, a defensive in the number 4 spot as doing well this year. It's confusing time.
It is a confusing time, and especially when you do have some of the more bullish sentiments still being around some areas that have performed well last year. And so for that trade to still be intact, or at least top of mind for some investors, and thinking about energy, and then additionally, you think about healthcare as one of the thematic plays for 2023 that continues to get brought up. This could just potentially add on, at least in the first half of the year, until we do see more of that mullet trade that I keep bringing up that Brent Thill discussed with us on the show before. If you see more of that party in the back, where could some of the high growth internet names, you're laughing, Sozzi, where could that come back in to play for portfolios?